Welcome to the daily update, where I'll go over the action in the market for Friday, September 13th, and then we'll see how things look for Monday, September 16th. Saw another update, up a little more than 0.5%. We're seeing pretty good momentum right now, not necessarily becoming overbought. Some of our short-term indicators are looking a little extreme positive, but we have a concern here that may or may not turn into something. Of course, the perma bears are already salivating about this. We now have a confirmed Hindenburg omen, and I've been showing that chart here in the videos. I'll get to that later in the video and show you how we have the first signal, and now there's a confirmation of that signal. And sometimes that can be pretty negative. We've seen that other times that I'll go through and show you what has happened, especially when we get a confirmed one. Now, what the perma bears sometimes do is they just see one little signal and they go, oh, here it is, market's falling apart. Well, this is a confirmed signal. So we want to not be afraid of that, but at the same time, watch our other charts, see what's developing, and then just go with it as things change. So I do have a thing called the SPXInvesting Program. There's a link below this video that will take you to the site. It's free for right now. I will be locking that down at some point, but feel free to check that out because there are additional posts and videos that I put on there that I don't put on YouTube or Rumble. There's also a link that will take you to a video that talks about the program. And if you have any questions, you're more than welcome to send me an email. And if you are a member, you get immediate access to the videos as they're prepared and uploaded, where I delay those on YouTube and Rumble. The daily video is the real foundation of the hub that I do. Now we're over the weekend, so I'll be doing all these outside videos, but they're all meant to tie in to the daily video. So let's go back and talk about what happened and then look at some charts. We had a higher open and prices climbed above R1 at 56.19. So now we're above that 5,600 level. Then we just stayed above that level. We chopped around going sideways, and then we closed slightly above R1. So we didn't see an awful lot of selling. We saw enough buying to take things higher, and then we just kind of drifted as the day went on. We were up 0.54% on below average volume, something to be a little bit concerned about. We've seen the last 2 days now be somewhat below average when it comes to volume, but our charts are showing a lot of improvement, and even some of our charts that are based on volume are also looking a little bit better. But at the same time, we want to see an increase in volume when we go up. And if you're positive on the market, you want to see a decrease in volume as we go down. It's not really showing any kind of a trend at this point, but we just want to be aware of that. We are now positive in the short, intermediate, and long term. So we switched over to a positive stance across all the different time frames. Of course, we want to watch all of the geopolitical things going on, not really having much of an impact on the market, but that can always change. Okay, small caps had a pretty good day, but they haven't really broken out. They just got to the higher end of the range they've been in lately. And the ADX, or the average directional movement, which is probably the main indicator that I follow, even though I show lots of different charts to confirm what I'm seeing with the ADX, we're seeing the green line crossing above the red line. So now we're defaulting back over to looking positive, but we're not trending right now because we're below the moving average and we're also under 20. So if this is going to be something positive, it means we're just kind of getting going with this. So we just see that as something improving because it had been negative for quite a while there. And we did get the confirmed signal with the Hindenburg omen, which happened really on Thursday. There's a 1-day lag from the time that they update the chart until I can actually see that. We're 1 business day behind. And we're getting a little bit of a list now in the short term with the Stochh RSI, the Williams percent R, and the stochastics. And these are the usual charts that tend to look extreme positive when we're moving up. They also tend to look extreme negative when we're going down. And then long term, we don't have anything in the intermediate term, at least right now. We look at in the long term anyway, the 150 and the 200 simple moving averages. Now, this could also suggests good longer-term momentum, which is what we've been seeing for the most part. The scenario really hasn't changed. The Fed's going to be meeting in the upcoming week. They're probably going to cut, well, they are going to cut rates. It's just how much. And I'll go over that in the weekend videos and look at the probabilities. Is it going to be 25 basis points or 50 basis points? The dollar was down and interest rates were down. These also gave some support to stocks. Usually we want to keep an eye on interest rates because they're really dropping right now, especially I'll go over this in the weekly video as well. The 3-month yield is dropping, and that can be good, but it can get to the point where maybe it's too good and it actually changes over to be negative. So we're keeping an eye on that one. But we settled after Friday at 3.65% with the 10-year yield, where we had been at 3.68%. We're still inverted with the 10 to the 3-month, and that's probably still going to take a while. It has a ways to go before that becomes uninverted, but the 10 to the 2-year has now remained inverted for a number of days. And we're getting up a little bit again with our sentiment. We're getting back into neutral territory where we had been negative. After Thursday, we were at 43. After Friday, we've climbed up to 49. And we're not trending now, but we are turning positive with the ADX. And the bias is positive with the update, and the last number of days taken together, that's what I use to subjectively gauge momentum. That is also positive now. All right, we did get, I'll just go through some of the numbers on these, but I don't have charts to follow them up. Where a couple of them, at least with consumer sentiment, I will show you that chart. But export prices were down 0.7%, where last time they were up 0.5%. When you take out agriculture, we were down 0.6%, where last time they were up 0.8%. And import prices were down 0.3%. Last time they were up 0.1%. And you take out oil, they were down 0.1%. Last time they were up 0.1%. This is the one that I'll show the chart. The preliminary reading for consumer sentiment came in at 69, where they expected 68.1. So a little better than expected there. And that tends to help the market. That just means folks are feeling a little bit better about things. And it's up from 67.9 that we saw last time. So here's the chart of consumer sentiment. The blue line here, this is the main number that I just focused on. It is going back up a little bit. And when folks look out or look at how things are going right now, they had been more pessimistic about things. That bounced back up with the purple line, and then the yellow line, future. That's how are people feeling down the road. So we're seeing pretty much across the board improvement right now. And here's the chart that we look at, where I also compared the 2-year treasury yield on this as well, where both had been really coming down. Well, we're kind of stabilizing a bit with the 2-year, but we're starting to go back up a little bit here with the consumer sentiment reading. And then looking at this is where the S&P is. And of course, you could draw all these lines over here because these are the only things that really the S&P can do. It can go up from here, it can go sideways, or it could go down from here. And these are just some different levels that Goldman Sachs came up with here. And we're right around at that 5,600 level. We're a little bit above it right now. So thinking that maybe things could go up, maybe things will go down. But I mean, this is like throwing darts at a dartboard. Just different levels that they've come up with, depending on if things stay positive or turn more negative based on the earnings per share that they're coming in with. And this is really nothing much to do with the market itself, other than folks who are investing right now. But it just shows that millennials are now the biggest voting bloc. For a long time, it was the baby boomers, but they're starting to drop off as they're getting older. And then here, despite the recent upsurge or uptick, I have to move this bar, in unemployment, our recession risk estimate remains low. This is another Goldman Sachs chart. This is what they think. They went up a little bit thinking, this is when everybody freaked out at the beginning of August when that employment situation report came out weaker. And then later on, they revised it down when the next report came out. But they still haven't really changed their fear of a recession, where the Bloomberg consensus also has this going down. Now, this can always change. Things can happen relatively quickly, but we often get clues by looking at our charts to see if we're actually going to switch over and go into a recession. I did an updated video this past week on the website that goes through a lot of the charts that we look at to see, are we going to go into a recession or are we not? And the speculative mood, Bitcoin versus the NASDAQ, there's a fairly strong correlation between the two, and both have been under pressure lately, but we're seeing at least the NASDAQ starting to bounce back as things are looking a little better. And then the easing rate pressure should translate into a pickup in manufacturing, because if companies don't have to pay out as much in interest, well, let's hire some people, let's build some new products, let's expand a little bit here. So we're seeing the 10-year yield going down, and that it might help things a little bit. But here it's a 15-month lag. I don't put a lot of weight into these shifted around charts, because if you shift them around long enough, you can come up with any scenario that you like. And bond ETF flows, we're seeing a lot of money really going into global high-grade bonds. These are more conservative bonds, not like junk bonds. When you take out the emerging markets, a lot of money going in there. We're seeing some money coming back into the high-yield bonds, and not really as much interest right now in the emerging markets. And global equity fund flows by the month, we're seeing a lot of money coming out. As we were seeing some weakness there in August, people are freaking out, taking their money out of the market. But if you look at this chart a week from now, it'll probably go back up, because people are probably experiencing a little bit of FOMO, or the fear of missing out, and they're going to be jumping back in. Then I did find a couple charts here. This is from Real Investment Advice. And I say this a lot throughout the videos and in the courses that I teach, where it says, earnings ultimately drive stock prices. And this is longer term. This is the annual change in earnings is the best indicator, because earnings are what ultimately allow a stock to either go up or down. And we see, going all the way back here into the 90s, a really strong correlation between earnings changes on a year-over-year basis versus how the S&P ends up performing. This is also kind of going in line with the VIX chart that we've been following. We're coming into a period of time, usually about halfway through September into October, up until the election. We tend to see a lot of volatility, and that can mean downward pressure. Doesn't mean we will this time, but historically that is what has happened. September and October can often be pretty negative months for the market, but October especially can also be a very good month for the market. But we just see a real pickup in volatility during this time. We want to keep an eye on that. And then inflation against a spread between PPI and CPI. And Lance over here says it confirms that price increases are being retained by producers. So the companies that make these things, they're not raising their prices so much, which is deflationary in and of itself. But these companies that make these products, that means that they have to soak up that it bites into their earnings, because they have to take in those price increases that they should be making. They're not doing that, even though their costs are going up. And this could have an effect. So on one hand, as a consumer, you like this because they're not passing on the price necessarily to you. But as a shareholder of one of these companies, you may not like that, because it could bite into the earnings of that company. All right, here's our intraday chart, and we've had a really nice move up here. We were going down with a vengeance back on Wednesday, and then we finally hit bottom at the previous low that was set a week ago, Friday. And we have gone up really solid since then, and we closed pretty much at the high for the week, just a little bit off of the high here. But in Friday's session, we did gap higher. We got above R1, and we just stayed above R1. That even acted as support later in the day, and then we just kind of drifted a little bit up going into the close. And we saw a little bit of an improvement with the pre-market session here with the futures. And so they were just kind of building up and getting a little bit better before the cash market even opened. This is still a bit of a concern to us, but it could be improving, where we're seeing both the red line and the blue line, for the most part, going up. We want to see the blue line above the red line, even though they're on different scales. But this would mean that growth is outperforming value on an intraday basis. And this is also showing some improvement. Now, back in August, we kind of topped out, and for the most part, we were headed down. That's when the S&P was going down. When this starts to go back up, that helps the S&P to go higher. When we look at this intraday growth to value ratio, we're pretty much level in Friday's session. So here's an end of day chart where growth was up, but up less than value. It was up less for the mid caps and up strong, but up less for the small caps. So coming down a little bit here with our small cap growth to value ratio, we want to see this going up. That would be more positive. Same thing with mid cap growth to value. It was flat, but we want to see this going up, and it's just not doing that. We are seeing a little bit of more of an uptick here with S&P growth to value, but we want to see this continue to go up to remain more positive. We look at the ETF, a growth ETF and a value ETF, showing some improvement here. Even though it was down a little bit on Friday, we dropped down below the rainbow, and then we've been coming back up into the rainbow, improving slightly. We want to see discretionary outperforming staples. I'm looking at the bottom part of this chart. It went above both of the moving averages here, but we want to see more of a sustained move up to be more positive on this. Large cap growth above its 50-day moving average and looking pretty solid right now. It was up 0.39%. And our trend, the ADX was kind of mixed up there for a while. It was picking up this red line being on top, and it was starting to develop a negative trend. Well, with the reversal that we saw on Wednesday in the up move, that's pushing the ADX back down, as it's like, okay, I'm not sure what's happening next. But we are seeing the green line going above the red line now. So now we default over to positive until proven otherwise. And in the short term, we're also seeing the green line above the red line. Both the moving average and the ADX itself are below 20. So we're still not in a trending environment. And we're dropping off a little bit here. The last couple of days with the upward moves that we've seen, we're on below average volume. And that's just a little bit of a concern, something to be aware of there. Sentiment is still kind of high here, according to the Ulcer Index. We're still above the moving average, even though we're flattening out here. We're coming down with the VIX, dropping below the moving average with the line chart as well as the bar chart. And when the VIX goes down, the VIX of the VIX also declines, showing that fear is decreasing and volatility is decreasing. And we're actually dropping back over with the MACD. We've turned over negative here. So now the momentum of the VIX is down where it had been going back up. This is the seasonal chart, and this kind of matches up with the chart that I showed a little while ago, with volatility really picking up in through September and into October. The VIX historically will have a tendency to rise, and when this is happening, that means stocks are going down. We'll have to see if things end up playing out that way as September and then we go into October play out themselves. And we declined with this fear gauge here. We also declined with this other fear gauge. So we're seeing more confirmation that fear is decreasing right now, and not necessarily extreme at this point. Coming back up here with the risk on ratio, this has been bouncing up as stocks have been bouncing back up. For this to keep going up would be more positive for the S&P 500. And we look at large caps versus small caps. We declined a little bit here. Small caps had one of those big thrust up days without really going anywhere necessarily. But overall, we've been seeing where the large caps continue to outperform small caps. We're keeping an eye on this, which really we don't see all that much from this chart. What I've done on the next chart is this is an inverted version in the middle area of the chart we just saw, and then it matches up with what the S&P is doing. And this ticked down a little bit on Friday, and that's more positive. We want this to go up. That means that fear between the risky and not as risky bonds is decreasing. If this is going down, that means there's more fear. And anytime you get fear in the market, that usually means things are going down. And then just to give it a little bit more perspective, we also look at this with an inverted version of the VIX, which has been going up on this chart, which because it's inverted means the VIX has been going down. We did decline with the equity put call daily chart, so we're continuing to decline with the 5-day and the 10-day. This is showing there's not a lot of fear. Fear is decreasing in the market right now. And we're down to kind of coming out of the bottom end of this band here with the volatility risk premium as we're seeing fear tapering off. And we're looking pretty good here with the advanced decline line studies. A little bit of a concern in that we're breaking out just barely here based on price. we're lagging just a little bit here. You might be able to make a case that we're breaking out based on volume. Some of our other charts are looking a little more positive when we take volume into account. So maybe you could say we're breaking out a little bit here. So that would be more of a confirmation. And we saw an expansion of the new highs, very few new lows in Friday's session. We're trying to turn back up with the 5-day, and we're starting to flatten out here with our 10-day moving average of the new highs minus the new lows. And we're above zero and going up with our advanced decline ratios. And when we break out the 19-day advanced decline ratio, we're above zero and going up based on price, and we're above zero and going up based on volume. So this is positive. And after switching over negative for a few days, we're turning back over positive with accumulation distribution, a smart money indicator. We're above the moving average and going up. And the longer we stay above this, the more the moving average will go up. And then to try to measure the distance from the indicator to the moving average is the boom indicator down below. We're above the midpoint and climbing. But this is a little bit of a concern. We're tapering off a little bit with the Chaikin money flow. It's still positive since we're green, but the red line's coming down a little bit because these types of indicators not only take price into account, they take volume into account. And the last couple of days with below average volume, this indicator's picking that up, and it could be a little bit of a warning sign, but we're not seeing that reflected in price, at least yet. We are, though, looking positive here with the Chaikin oscillator. Earlier in the week, we were negative. We crossed back above the midpoint to turn positive, and we continue to go up. The vortex, just barely seeing the green line crossing back above the red line. This is another primary indicator that I use, and this is turning back to positive. And we look at the new highs, new lows, just the daily score on top, and we're above zero. So that's pretty healthy. And then this is a 50-period moving average where it's still declining here. This takes longer for this to turn around. And it was picking up the declines that we were seeing last week. If this can turn and go back up, that would be more positive. And this is that same chart, just shown in a little different way here, where we're still basically declining here, but trying to make a turn to go up. And then we look at the S&P 500 based on price with the cumulative measure here, breaking out based on price and almost breaking out here based on volume. That could be positive and so almost showing a confirmation there. We compare the S&P with the NYSE advanced decline line. Both are pretty much in lockstep right now, even though they're on different scales. That just shows that the broader market is also hanging in there as well. And then here's the NYSE new highs minus the new lows, really going up with a strong score after Friday and above zero. So this is looking good from a broader market perspective. This is a 50-period moving average of that daily score, which it's continuing to go up, and that's positive for the broader market. Then we look at a cumulative NYSE advanced decline line based on price, really up solid on Friday, and the advanced decline line is continuing to go up as well. That's positive. And this is another advanced decline line measured in a slightly different way, also showing an improvement. We break it out based on common stock. We haven't quite broken out yet based on price. This could be positive. We're actually breaking out a little bit here based on volume, and that tends to be more positive when volume leads price for the broader market here, the NYSE common stock. And we're showing an improvement with our advanced decline line studies, going back up with the NYSE common stock, the S&P is going up, the mid caps, and the small caps were able to cross back above their moving average. So this is looking, especially for the small caps, much improved. On a short-term basis, we're well above the 50-day moving average now, but we have not set a new all-time high with the S&P, but we're still in a longer-term uptrend. The concern that I've been pointing out is both in Thursday and Friday sessions, we were below this moving average when we look at volume. And on a 5-day basis, because we've really reversed here, we may have overdone it a little bit. This is a 5-day rate of change, and we're getting above this blue line, which doesn't necessarily mean a reversal. It just means that maybe we've been going up pretty fast over a 5-day period of time. We're going back up with our 20, 50, and 200 period moving averages. So this is just on the S&P itself, not the stocks inside of the S&P. This is showing an improvement here. We're starting to get extreme positive with the Stochk RSI, but that could also suggest good short-term momentum. We're seeing that same thing here with the Williams percent R. The CCI 14 is above the midpoint and going up. So that's still positive without being extreme. And we're also above the midpoint with our CCI 20. So our short-term indicators are looking positive right now. The condition of the 20 period moving average, we're above the lines, both this green line and blue line, and they are starting to turn back up. So we've switched back now in the short term to positive. This is a simple and exponential moving average, or averages based on 20 periods. We're above both. What would turn this even more positive is if the blue line, which is the exponential moving average, would cross back above the red line, because the exponential moves faster than the simple moving average. But for right now, this is positive. We're looking a little extreme in the short term stochastics. And the reason I say that is the short, intermediate, and long term, this is a further subdivision of the short-term time frame. Stochastics are pretty touchy. And so we're getting a little extreme in the short term, positive in the intermediate term, crossing back above its moving average in the long term. So we're looking positive again here with all of our stochastics charts. With the force index, we're above 0 and positive, and we're coming up into the +2 channel. Where we get concerned with this is if we get up to the +3 channel, which you can't even see right now. That means that we're going up a little too far too fast, but it could also suggest good momentum. Right now, based on what we see, this is looking pretty healthy. And we're coming back up with those stocks inside of the S&P above their 20 period moving averages. We actually dropped below 50 there briefly, but we've been improving here. And we're going up with our 50 period moving average study, our 100 and our 200 period moving average study. So across all the different moving averages that we look at, we're seeing some improvement with the S&P. Intermediate term, we've gone back to positive with the balance of power. We've crossed above the midpoint. This is the condition of the 50 period moving average. We're above both lines and the lines are starting to turn up. It would be more positive if the red line would cross back above the blue line. That's a triple versus a double exponential moving average, and the triple moves faster. And we're above both the simple and exponential moving averages here. Again, it would be more positive if the blue line went above the red line. But since we're above both, that is positive for the intermediate term. Here's all the moving averages, and we're above all of them right now. So we're looking pretty positive on a moving average basis. We're still positive with the go, no go with the blue bars. And we're coming up here to the blue line here with the highest high value. That's positive, and we're above the midpoint, and the midpoint is starting to turn back up. But the TTM squeeze is still negative. Now it's slowed down a bit here, but this isn't confirming the upward move that we've been seeing. And I know a lot of you that watch these videos, you use the TTM squeeze, and you're probably a little frustrated right now. It would be more positive if we could see this start to go back up. And standard deviation over the last 10 periods, this is just measuring speed, not direction. And we're above the moving average. And since we've been going up and moving rather quickly, that's why the standard deviations chart is going up as well. We're still negative with the ease of movement, but we're improving. The Erin indicator is actually trailing off, but we're still positive with that since we're above 0. What this does is you see the green line, these are buyers, and it shows them decreasing. And the sellers are the red line, and they pegged all the way at the bottom. But when you take the difference between the two, we get a positive result for the oscillator, but that's been trailing off a bit lately. And we're turning back positive again with the S&P 500 McClellan oscillator. We had been below 0, and that was a concern for us. That's more short. Well, this really is short to a little bit intermediate term of an indicator, but we crossed back above 0. And then when this is above 0, the next chart, we're starting to turn back up with the summation index based on price. So this is turning positive. And a few days before that, we were starting to turn up based on volume. So the idea that volume is leading price can be taken as positive. And we had gone negative with the NYSE McClellan oscillator, and this is crossing back above 0 now. So we're starting to tick back up with the summation index based on price and volume. And we're turning positive again here with the Swenlin trading oscillator. We were concerned. We'd actually crossed over positive based on volume, but that wasn't confirmed by price. Now both of them are above 0 and advancing. So this is positive as well. The momentum's trying to shift back over and look more positive. We're turning back up, but coming right up to the moving average of the PMO, turning up slightly here based on price and looking a little bit stronger with the turn up based on volume. And that can be taken as a good sign. We're seeing the PMOs that are rising, showing an improvement. We're turning back up with the buy signals and starting to go back up here with the PMOs above zero. We are positive with the Elder's Impulse system for the S&P. We're positive for the second day now with the parabolic SAR. This is a primary indicator, and it went from being negative with the dots on top to positive with the dots underneath. The slope oscillator is still negative, but trying to turn up. This is our shortest term oscillator that we follow. The MACD is actually coming back up to its moving average and showing some improvement. So we're trying to turn back up here with the slope. We're actually in the midst of turning positive with the TSI, another short-term oscillator. The MACD is trying to come back up. We're trying to come back up with the PMO and the PPO. Haven't really seen much of a turn yet with our longer-term oscillators, the TRIX and KST. And we're turning back up, but still negative here with the Copic curve. Getting almost extreme here with the Sean trend meter. If we get up into this darker green area, that's when it's starting to look a little extreme. If it gets up into this even darker green area, that's when it's really extreme positive. This is what I was kind of warning about, or just a little bit concerned about, is the bullish percent index, which measures the point and figure buy or sell signals of stocks inside the S&P. We were going up, and this was going down at one point and actually just barely ticking up. Well, we saw a nice little advance in the BPI in Friday's session. So this is positive since it's above 50, and now that it's going up and showing some movement here, that's even more positive. Going back up with the NYSE bullish percent index, and we cross back above zero and are advancing with the NASDAQ 100 bullish percent index. And we're back to looking positive here with the ultimate oscillator since we're above 50. We were flat, but we're above 50 with the money flow index, above the moving average with on-balance volume and advancing there. We're back above 50 with the RSI 14 and 9. So our momentum is looking pretty good right now. And we're breaking out above this 20-period moving average study of the high, open, high, low, and close. This can sometimes act as resistance, and it did there a few times along the way. But the fact that we closed above this is turning this more positive, and that the lines are going up. That's also positive. And this is a weekly chart of the S&P. We were able to close above this R2 level. Now, we haven't set a new all-time high, but this is longer term, and this is also positive for the S&P. So we're turning back to positive here with the Heiken Ashi chart with the open candles. We're still negative since we're red with the Kagi chart, but we're pointing up. We're seeing an open block here with the Renko chart. That's positive, and the 3-line break is now turning more positive. And in the long term, we're getting above this red line here with the 150 and 200 period moving averages. Now, as I always say, I put these lines on here just as reference points. Doesn't necessarily mean that we're going to stop, and we could go well above this red line. We've done that before. I just use this as kind of a visual guide. And we're positive across the board according to the Keller market model with all the different indexes. And we're still positive across the board with stocks and bonds, but we're negative across the board with commodities and the dollar. All of the different sectors were positive. We saw utilities up, and this is a more of a defensive play. I know you could possibly take this as a growth play because of the whole switch over to EVs and all the Bitcoin and crypto mining and what they're doing to generate electricity and all those things. That could be some kind of a growth play, but typically, historically, it has been more of a defensive play. And that's what we've been watching here, because a lot of times you'll see a real pickup in utilities, staples, and even real estate to a degree, and healthcare, because these are more defensive. When these areas start to really do well, that's more of a defensive posture for the market. And that's what we saw right at the end of 2021. And then that led us into 2022. But this has been going on for a while now, and it hasn't really led to anything really substantial. We'll have to see as September plays out, will it turn into something more substantial? Everything was green. No Christmas happening on Friday here. Just all green here. I guess it could be St. Patrick's Day. Everything looking pretty good. Even Canada set a new all-time high with the NASDAQ crossing above some major round numbers here. We had a MACD crossover for the NASDAQ. The BPI went above 50. That's turning back positive. That's a chart I don't show. Real estate is setting a 2-year high. Industrials had a BPI across 70. That's good for the economy. Well, I guess then Canada went on to set a 4-year high here. So all-time high, then a 4-year high. Okay. Maybe it came back down a little bit. This is an area that's a little bit of a concern. The staples, this is more defensive, and this is having a BPI cross above 70 right now. And we compare the S&P 500, which is a weighted index, so the big Magnificent Seven stocks have more of an impact, versus the equal weight version of the S&P, excuse me, where they're going more in lockstep right now. That just means that the broader market is participating in this up move. We came down just a little bit as the equal weight slightly outperformed the S&P weighted index in Friday's session. But overall, this has been bouncing up since we've been seeing the S&P bouncing back up after Wednesday or during Wednesday. This is a broad market measure of a 5-period moving average of the highs minus the lows. We're still above zero. This is also suggesting good broad market strength. The Dow not setting an all-time high. It was just a little over a week ago when it did, and it was up 0.72% above its 50-day moving average. Excuse me. And it's still looking positive here with the diamonds for the Elders Impulse system. This is rather critical, though. We were worried that the NASDAQ was having trouble getting above its 50-day moving average. It closed above that on Friday. And we were also seeing that for the NASDAQ 100. It also closed above its 50-day moving average. So we're positive with the Elders Impulse system with the QQQs. And we're turning back to positive with the momentum of the NASDAQ 100 as measured by the PPO. This is crossing back above its moving average. It will be even more positive if it gets above the midpoint. We're above all the plotted moving averages still here with the QQQs. That's showing a lot of improvement as well. And here's the small caps. They were up 2.5%, but they still have a ways to go to get back to these previous levels that we've been at earlier. But on the positive side, they were able to get back above their 50-day moving average. And then we look at another small cap index, the Russell 2000, crossing back above 50 with the RSI. That's positive, getting above their 50-day moving average. Not quite there yet, but turning positive here with the momentum. And we've gone from neutral to positive with the small caps when looking at the Elders Impulse system. This is also encouraging. The mid caps were able to get back above their 50-day moving average and close above this pivot point. Not really going anywhere yet, where we haven't already been, but this was stronger earlier in the year, and now it was kind of fading as far as having an impact on the market. It's showing some improvement right now and still has yet to prove itself if it's going to become more of a leader again. And they've gone from being neutral to positive with the Elders Impulse system for the mid caps. This is also a broad measure market here, the Wilshire 5000, above the 50-day moving average, but not setting an all-time high, at least yet. This is a total U.S. stock ETF, also above its 50-day moving average, up 0.7%, looking pretty solid here. And staples to tech ratio, after really going back up, which is negative for the tech sector, it means it's underperforming. Now we're starting to go back down with this ratio. Financial sector came all the way down to their 50-day moving average and have been bouncing up off of that. And this has been one of the stronger sectors. We want to keep an eye on this. And we're watching that 3-month yield. We're watching all the interest rates, because if they really start to go down because something bad is happening, that's a whole different context. And it'll probably take the financial sector down with it. So this holding up is pretty good for right now. And this is also encouraging. We were able to get back above the 50-day moving average with the FANG index and keep that on Friday and actually build a little bit. Excuse me, with having to clear my throat here. With the FANG index, we did drop below the shorter term trend line. We haven't been able to get back above that yet. But then we had a longer term trend line here that we also fell below. We've been able to get above that, and we're right in between these two trend lines right now. Then we look at the Magnificent 7+1. There's one in here that I have 8 charts that I go through. Where we have Apple, it was down slightly, but at its 50-day moving average. Microsoft, after coming down and dropping below its 200-day moving average, is now going back above its 50-day moving average. Amazon also toying around with its 200-day moving average, and it was down in Friday's session, but still above its 50-day moving average. And we're seeing Google coming back and closing just a little bit above its 200-day moving average. And Meta is a little bit above its 50-day moving average, even though a lot of these stocks were down. And this is what held the S&P 500 in check a little bit here. NVIDIA was virtually unchanged and right back up to its 50-day moving average. Tesla was up 0.21%, a little bit above its 50-day moving average. And then Netflix has been looking pretty good, up 1.49% and looking fairly solid here. Then we look at a ratio between US stocks and international stocks. The shorter term relationship is starting to weaken a little bit between the two, meaning that US stocks are outperforming. But the longer term relationship is still pretty much intact. Oil continues to be below 70. We're watching this mainly for geopolitical reasons in case things really escalate in the Middle East. And we want to keep an eye on the staples sector. This just keeps going up and up and up here. But it's been doing that for quite a while. And we've been watching this, and I've been mentioning this. It really hasn't led to anything yet, but that doesn't mean something won't develop at some point. And utilities also just busting out here and looking really solid right now. Typically a defensive play. That's why we've been watching this. And healthcare, another defensive play. Not really breaking out, but still in a pretty solid uptrend here. Real estate also looking pretty good. It likes that interest rates are going down. And the dollar is in a downtrend here and did decline in Friday's session. And we saw a recent death cross here with the daily chart. And we're going down with the 10-year yield. Rates are really dropping. Most of the forecasts that I saw looked at the 10-year yield to be about 4 to 4.25%. Well, we're dropping way below that now. And so when we go down with the 10-year yield, we go up with the 10-year based on price. This is the 10 to the 2 yield curve where we come back above the zero line. That means it's no longer inverted. And this will typically start the countdown to see if we're going to go into a recession. I don't have the chart here, but we also look at the 10 to the 3 month. If that goes back to being normal again, that kind of is like a double whammy to see, okay, we really need to see if we're going to go into a recession. But the market is still banking on this idea of a soft landing, that we won't go into a recession. And I'll deal with that in a lot of those charts over the weekend in the weekly videos. And then we're seeing some improvement here with the Qs to S&P when we look at our growth to value ratios. Discretionary has actually been doing pretty good here, where it's been really disappointing for the most part in 2024. Can it keep this up? And we're seeing a bit of an improvement here when we look at large cap growth versus large cap value. So we're seeing an improvement with the large caps coming back up to the mid or the moving average here, excuse me here, with the mid caps and coming back down to the moving average with the small caps. Okay, one more time there. And we're not really going up here. This is a little bit of a warning sign. We want to see the S&P to utilities ratio really going up, and it's been going down and kind of floundering around. And that's usually because, I mean, the S&P's been doing pretty good this week, but utilities have also been doing good, and that's what's keeping this ratio down. And we are going down a little bit here. Even though staples have been doing well, they're starting to come down when we do a ratio between staples and the S&P 500. We want this to continue to go down if we're more positive. If we switch over negative, that's when we see this ratio starting to go back up. So here's the Hindenburg-Ullman. And if you don't know what that is, just pause this and read through all this malarkey here. Really, there are 3 conditions that need to be met for a Hindenburg-Ullman to be real. Hindenburg, of course, was all the humanity, the big blimp that blew up and all of that. The perma bears just love this thing. And this is where I initially found out about the Hindenburg-Ullman was I don't really pay attention to the perma bears, but I get their emails and, oh man, I got one email, it's like 5 of these mentioning the Hindenburg-Ullman just in the last couple of days. But when you look at just one signal by itself, the track record's really bad. Okay. And I don't know why they get all excited about it. When you see a confirmed Hindenburg-Ullman, okay, the track record is not always all that great, but it's worth paying attention to anyway. So here is the chart. We saw the first signal back on September 5th. That's when we spiked up here. And then we came down. Well, then after Thursday, which was September 12th, we saw another spike up. And that is now a confirmation. So it was confirmed on the 12th of September. Now, you can look at other times when and if we get even more spikes, that will likely even bring in some more validity to this. But this was right before the COVID crash. We saw a number of different spikes here, and then boom, we just went in the toilet. And then we saw, over a period of time here, a series of additional confirmations. This was at the end of 2021, before we went into 2022. Now, we've seen other spikes along the way. Now, the NASDAQ has not triggered a Hindenburg Omen yet, let alone a confirmed one, but not even a signal at all. So we want to just pay attention to this and see, okay, is this going to bring some weakness into the market? So what's our outlook for Monday? We are turning positive now and we're improving, and we have a confirmed Hindenburg Omen. So that's more of a negative sign, but our charts right now are looking positive and even getting better. We're going to get the New York Fed Empire State Manufacturing on Monday. That's it on Monday. And then the geopolitical things going on. And while I'm thinking about it, those of you that have followed the video for this long through this particular video, there will be no video on Tuesday. I'm going to be traveling that day. And so I'm actually starting Monday night where I live, and I'll be traveling all day on Tuesday. I'll prepare a video this is the video for Monday, and I'm hoping to develop one for Wednesday, but there will not be a video on Tuesday. And here's the upcoming economic calendar. The big one's going to be retail sales on Tuesday. And then I think this is pretty important because it tells us what's going on economically with industrial production and capacity utilization. And then the big thing is going to be Wednesday when the Fed says, yes, we are cutting rates, and by how much. And then because we're paying attention so much to the employment situation right now, we want to keep an eye on jobless claims and continuing claims. We're also going to get LEI, and then we don't have any reports coming out on Friday. And this is just showing the more important reports coming out. Nothing for Monday's session. It'll be retail sales on Tuesday. That'll be kind of big. Seasonality, we are positive for September 16th with the Dow, but we're neutral to positive with the S&P, and we're neutral to negative with the NASDAQ. So over the last 20 years or so, we've kind of hit the whole range here. We will be coming into options expiration. Now, over the going back to 1980, we're up 55% of the time and down 45% of the time during options expiration week. We do see a little bit of a trailing off here with the Stock Traders Almanac for the 10th trading day of the month, which will be September 16th. But then Monday tends to be quite positive. This was the best performing day in 2023. And it's also been pretty good here in 2024, where we have all of the days positive, at least for this year. And then we're coming up closer to that time. We're going to be at the 16th here, 17th, 18th, and then it's right around the 19th of September. According to this chart, this is when we see some real weakness coming into the market. We don't know if it'll play out that way, but historically, this is what has happened. And we're kind of trailing along here. This chart's just a little bit out of date right now, but we do see some weakness going on here, at least compared to what happened in 2023, and then comparing it with 2024. So we do have a confirmed Hindenburg Omen, and that'll kind of be indefinitely on this list until it no longer seems to apply. And we are keeping an eye on these defensive sectors like staples, utilities, and healthcare. We're keeping an eye on energy just in case that turns more geopolitical in nature. Our oscillators for the S&P, they're trying to turn positive, but they are showing some improvement there. The ease of movement is still negative, but improving, and the Copic curve turning back up, but is still negative. We're seeing some improvement with growth of value, especially for the S&P, and that's encouraging. And we're seeing a little bit of a tick up with discretionary to staples, but we still need to see more follow through with this. And then our positive signs, we have accumulation distribution, the chicken money flow. Even though it did decline on Friday, it's a little bit of a concern, but we have a good solid update on Monday that could take that away quickly. But we also want to pay attention to that in case it's telling us something that we're not seeing in the other charts. And our chicken oscillator positive. And I tend to use these three indicators together as one unit. These are our smart money indicators. The equity put call ratio based on 5 and 10 days are going down. That's more positive. That means fears coming out of the market as people aren't buying as many puts to hedge or protect their positions. The advanced decline lines are looking pretty good. And now we have both the S&P and NYSE McClellan oscillators and summation indexes that have turned positive. And the Swenlin trading oscillator is now positive, the parabolic SAR. And we're looking at the bullish percent indexes for the S&P, the NASDAQ 100, and the NYSE, all positive now. The vortex, the green line, is just trying to move above that red line, so it's crossing over positive. The money flow is positive, the ultimate oscillator, and now the momentum for the NASDAQ 100 is positive. And we want to keep an eye on the financial sector, but so far it's holding up quite well. So our conclusion, we're turning positive and we are improving, but we now have a confirmed Hindenburg omen. In the short term, we're positive and showing positive momentum. That's our short-term indicators are starting to get extreme here, which you could also suggest that we're slightly overbought. And we are positive in the intermediate term, but we have the Hindenburg omen that we're probably going to be dealing with now for a while. But we continue to be positive in the long term, but we're overbought in the sense that we're getting above those lines with the 150 and 200 period moving averages. Thank you. I hope you found this helpful. I hope you have a really good weekend. Of course, you won't be watching this until after the close on Monday if you're not a member. So I hope you had a good weekend, and I will talk to you in the next video.